In 2023, the U.S. Securities and Exchange Commission issued a $19 million penalty to a major asset manager. The charge? Greenwashing. The target was DWS, a subsidiary of Deutsche Bank that manages over $900 billion in client assets from its headquarters in Frankfurt. To the public, DWS was a pioneer in sustainable investing. They marketed themselves as leaders in ESG, using advanced technology to ensure their investments had a positive impact on the environment and society. This record-breaking penalty shattered the idea that the multi-trillion-dollar sustainable investment market was being accurately measured or strictly regulated. To manage this massive green expansion, DWS hired Desiree Fixler in August 2020 as their first chief sustainability officer. As she began auditing the company's internal operations, she found a significant disconnect between the firm's public marketing and its daily investment practices. Federal investigators eventually zeroed in on 3 specific instances of documented fraud that Fixler discovered while working inside the bank. To see how a top-tier financial institution faked a sustainable empire, we have to examine the evidence that triggered the SEC investigation. The evidence of a failing system began with a single catastrophic investment, payment processor Wirecard. DWS lost roughly $650 million when the company collapsed, despite holding it in a fund supposedly reserved for sustainable businesses. Looking at the timeline, the failure is clear. By April 2020, independent audits publicly revealed over $1 billion missing from Wirecard's accounts. Yet in May, DWS still awarded Wirecard a high B rating for sustainability. Internal reports justified the high score by citing Wirecard's good business ethics and strong corporate governance, praising a company already exposed as a fraud. The Wirecard disaster provided documented proof that DWS's internal screening process was essentially ignoring real-world financial risks. Beyond individual stocks, investigators focused on the proprietary ESG engine, the technology DWS claimed was the sophisticated brains behind their green strategy. While DWS told clients this was world-class artificial intelligence, internal emails from executives described the technology as shit. The system had a logic flaw. It judged companies by counting the number of controversies rather than assessing severity. So it recommended Wirecard for having one controversy, while failing Amazon for multiple minor governance issues. The technology was so unreliable that the bank's most senior portfolio managers simply ignored the company's mandatory ESG policies when making investments. This technological failure created a system where executives could easily bypass rules to maintain their positions in high-risk companies. The final breaking point occurred during the preparations for the company's 2020 annual report. The board of directors planned to tell the world that $550 billion, more than half of all DWS assets, were officially ESG integrated. When Fixler audited that number, she found a massive gap. The firm had no system to track those assets, and at most, only $150 billion actually qualified. Fixler presented these findings directly to CEO Asoka Worman, demanding that the company stop reporting the fabricated figures to the public. Fixler was fired without warning on the exact day the fraudulent annual report was released to the public. Fixler became a whistleblower, taking her evidence to the Wall Street Journal and triggering a massive international scandal. The fallout was immediate. As the SEC and the FBI opened investigations in the U.S., German police conducted a high-profile raid on the DWS headquarters. Within weeks, the CEO stepped down, and nearly the entire senior management team was replaced. The internal evidence from a single whistleblower was enough to dismantle the leadership of a $900 billion financial titan. The SEC's $19 million fine targeted DWS specifically for making material misstatements and failing to follow the very ESG policies they sold to their clients. In the wake of the penalty, DWS's reporting changed drastically. Their claimed ESG assets dropped from $550 billion to just $84 billion. This case serves as a warning to the entire financial industry. The multi-trillion-dollar boom in sustainable investing is no longer a safe haven for empty marketing promises.